Okay, so like imagine you're on a roller coaster, right? Going up that first hill,
Hmm.
all that anticipation, excitement, maybe some nerves, and then whoosh, you plummet.
Yeah.
That's kind of what the Indian stock market feels like right now,
Yeah.
especially with that 1,400-point drop in the BSE Sensex on February 28th.
Right.
If you're listening to this and feeling a little uneasy watching your portfolio drop 6.7% since the beginning of February, well, you're definitely not alone.
Not at all. It's understandable to feel that way.
Right.
Yeah, big market swings can be unnerving.
Especially when,
Right.
especially when
All those headlines screaming, sell everything.
Yeah, exactly. But before we all like run for the exits and start selling everything,
Right.
let's take a deep dive into what's really going on. Is
Yeah.
this a sign that the Indian economy is in trouble, or is this just temporary?
Hmm.
Are we jumping ship, or are we buckling up and getting ready for the ride?
That is the million-dollar question.
It is.
And to answer that, I think we need to look beyond just knee-jerk reactions and those headlines.
Right, and it's so easy to get caught up in the blame game,
It is.
especially when we're talking about global trade tensions and tariffs and things.
Yeah.
Some people are saying, oh, it's Donald Trump's fault with his trade policies.
Right.
But we have some analysis from Anish Dewakli, co-CIO of ICICI Prudential Mutual Fund, and he suggests that it's not that simple. It's
Yeah.
not just about those external factors like tariffs. There's a lot going on inside India itself.
Yeah, what's really interesting here is that the analysis is pointing to a bunch of different factors,
Mhm.
both within the market and the broader economy. So it's not just one single thing that's causing this dip, but rather a complex interplay of a lot of different forces.
Okay, so let's unpack those forces a little.
Okay.
The analysis is giving us four main reasons for this market decline.
Okay.
First of all, it seems that some stocks, mainly in the mid and small cap segments, and I should probably clarify for our listeners that that just means companies of a certain size, right?
Right.
Got a little ahead of themselves.
Mm.
Their prices got way too high.
Yeah.
It's like they were running a marathon at a sprint pace.
Yes, this is a classic example of valuations outpacing the actual company performance.
Mhm.
You see this pretty often where investor enthusiasm kind of inflates prices beyond what the underlying fundamentals of the company would suggest.
So it's not that these companies are necessarily doing poorly.
Right.
It's just that their stock prices got too high too fast.
Exactly, and a pullback is almost always inevitable when that happens.
Yeah, that makes sense.
Hmm.
The second factor here, the analysis says, is a slowdown in the Indian economy in general.
Hmm.
Businesses aren't expanding as quickly, consumers aren't spending as much. It's like that runner hit a wall and needs to catch their breath for a minute.
Exactly. This kind of slowdown in demand, it ripples across all these different sectors.
Mm.
It impacts corporate earnings and then makes investors less confident about the future.
Right, it's all connected. Now, the third piece of the puzzle here is that foreign investors, they're also called FPIs, are pulling their money out of the Indian market.
Right.
And that sounds kind of worrying.
It is something to pay attention to, but it's important to remember that foreign investors are always evaluating global opportunities and moving their investments around accordingly. It could be that they're finding better returns in other places, or maybe they're reacting to other global economic trends. It doesn't necessarily mean that they're losing faith in the Indian economy overall.
Right, so not a vote of no confidence, but more like diversifying the portfolio.
Exactly.
Then finally, the analysis is pointing out that even some big multinational corporations, the MNCs, are cashing out too,
Right.
selling their stakes in Indian companies. And that's interesting because I would think they'd be in it for the long haul. Is that a sign that even they're nervous about what's going to happen in India?
Well, it may not be panic, but it could mean that even these big companies are seeing the current valuations as a good time to exit, and maybe they'll re-enter later at a better price.
So taking profits while they can.
Yeah.
So we've got all these internal and external factors at play. But before we jump to conclusions, let's step back and look at the big picture.
Right.
The analysis also assesses how healthy the fundamentals of the Indian economy are, the core strengths and weaknesses. So what's the story there? Is it all doom and gloom?
It's actually not. What's really striking is that despite all this concern in the market, the fundamentals of the Indian economy seem to be quite solid.
So it's not all bad news then?
No, not at all. In fact, there are some positive signs.
Okay.
For example, the analysis says that the current account deficit, which basically measures the difference between what India earns from exports and what it spends on imports,
Right.
is under control. And that's a key indicator of a stable economy.
Okay, so that's good news for those of us who aren't economists and need a little reminder of what all that means. Basically, it means India isn't spending way more than it's earning on the world stage.
Exactly.
What else does the analysis say?
Well, inflation The rate at which prices for goods and services increase is considered manageable.
Okay.
So that means the cost of living isn't out of control, which is super important for consumer confidence and people's spending power.
So we've got a pretty stable foundation there. What about all the big players in the economy? How are the banks and corporations doing?
Well, the analysis indicates that both the banks and the corporations are in relatively good financial healthies. They've got the resources to handle these short-term problems and potentially take advantage of opportunities when the market rebounds.
Okay, so a stable foundation, healthy institutions. What about the housing sector? That's always a good sign of how the whole economy is doing.
Yeah, definitely. And the analysis says that while the housing sector could use a boost, it's not in a crisis.
Yeah.
The main problem seems to be a lack of demand, not a fundamental weakness in the sector itself.
So it sounds like the Indian economy is more like that marathon runner that just needs someone to cheer them on and hand them a bottle of water, not someone that needs to be rushed to the hospital.
That's a great analogy.
Right. It just needs a little help to get back on track.
Yeah, it highlights the fact that while there are challenges, the potential for recovery is definitely there.
So what would that help look like? What are those things that could revitalize the Indian economy and get everything moving again? The analysis outlines a few key solutions, and I'm really interested to hear what you think about them.
Yeah, I'd love to dive into those too. It's all about figuring out the right combination of policies to address these challenges and really unlock India's growth potential.
Okay, so let's talk about those solutions that the analysis is talking about. Like,
Sure.
how do we help our marathon runner get that second wind? The
Yeah.
first thing they suggest is more government spending.
Hmm.
And I know we just had the union budget with all kinds of things allocated.
Right.
But they're saying even more needs to happen specifically to get the economy moving again.
Hmm.
So what do you think about that? Is it just like the more spending, the better, or can you overdo it?
Oh, that's a really important question.
Yeah.
You can't just throw money at a problem.
Yeah.
It has to be strategic. The analysis says that spending on infrastructure projects could be a good idea.
Okay.
Building the roads and the bridges that connect businesses and consumers and all the resources.
So like creating a foundation for growth.
Exactly.
Yeah.
And it creates jobs too. And demand for those materials, and everything gets more connected so businesses can operate and grow more easily.
Yeah, but wouldn't all that spending increase the deficit?
Well, yeah, that's a valid concern. It's a tough balance.
Yeah.
The government has to weigh the benefits of all that spending against the risk of adding to the national debt.
Right.
The analysis doesn't really go into detail on that, but something for policymakers to think about.
Yeah, too much debt is never a good thing. Okay, second suggestion. The analysis recommends support from the RBI, India's central bank, and they specifically talk about lower interest rates and something called liquidity injections.
Right.
Can you explain what all that means for those of us who aren't economists and how that would actually help?
Sure. So the RBI has all these different ways to influence the economy.
Yeah.
And interest rates are a big one. Lowering interest rates makes it cheaper for businesses to borrow money, so they're more likely to invest and grow.
Okay.
It also encourages consumers to take out loans for things like houses and cars, which increases demand in all those industries.
So it's kind of like giving the whole economy a boost.
Yeah, exactly, like a shot of caffeine.
Right.
And liquidity injections work in a similar way.
Okay.
It basically means the RBI is putting more money into the system, so the banks have more to lend to businesses and consumers.
So it's about keeping the cash flowing.
Yeah, exactly. But they have to be careful not to go too far. If rates are too low for too long, it can cause inflation because everyone's borrowing and spending more, which drives up prices. And too much liquidity can create bubbles, like what happened with the housing market in some countries before the 2008 crash.
Right, so it's finding that balance again.
Exactly. Enough support, but not so much that it creates problems later on.
Okay, makes sense. Now, the third suggestion, the analysis focuses on reviving the housing sector. They're saying it has a ripple effect on the whole economy. Why is that?
Well, the housing sector is connected to a lot of other industries.
Mm-hmm.
When people buy homes, they need building materials and furniture and appliances and everything else.
Mm-hmm.
It creates jobs in construction and real estate and all these related areas. So a strong housing market really helps the whole economy grow.
It's like they say, as goes housing, so goes the economy.
That's right. And it's not just buying new homes. Either renovations and repairs and even just decorating existing homes can help boost the economy too.
So even if people aren't buying brand new houses, there's still opportunity there. Okay, so if all three of these things happen, more government spending, RBI support, and a housing revival, The analysis seems to be saying the economy could recover in 6 to 12 months.
Mm-hmm.
Is that a realistic timeline?
It could happen, but it's hard to say for sure with the economy.
Yeah.
It depends on how well these policies are implemented and how quickly businesses and consumers respond. And of course, there are always those unexpected global events that can throw things off.
Right. No one can control everything,
Right.
but it sounds like there's at least some reason to be optimistic.
Yeah, I think so.
The analysis seems to be saying this is more of a correction, a temporary dip, not a full-blown crisis.
Yeah, and it's important to remember that these ups and downs are normal.
Mm-hmm.
Markets go up and they go down. Sometimes they grow fast, sometimes they slow down. It's just how things work.
Like that roller coaster we were talking about.
Exactly. There are going to be some thrills and some dips along the way.
Right.
But you get off eventually and hopefully you had a good time.
Exactly. And speaking of those ups and downs, let's go back to what the analysis says about this particular downturn. You
Right.
know, they specifically talk about whether it's a crash or a correction.
Right.
So what's their verdict? They're saying it's a correction, not a crash. But what does that actually mean? Like, what's the difference?
So a crash is a really sudden, huge drop in the market. Usually because of some big event or a crisis, like a steep, unexpected drop on that roller coaster that we talked about.
Yeah.
A correction, on the other hand, is more gradual. It's usually a drop of about 10% or more, and it kind of helps adjust those prices that got too high and bring things back to a more realistic level.
So it's more like a reality check.
Exactly. And the analysis says that these corrections are actually a normal part of how markets work.
Mm-hmm.
They're healthy even,
Okay.
and they can create opportunities for investors.
Because when prices drop, that can be a good time to buy,
That's right.
like a sale.
Exactly. And the analysis has some thoughts on which sectors might do well when the economy starts growing again.
Oh, interesting.
They're not giving specific advice or anything,
Right.
but they point to some areas
Yeah.
that investors might want to keep an eye on.
Okay, so if we're thinking like investors here, based on everything we've talked about, what do you think those opportunities might be? What sectors are going to come out on top after all this?
Well, if the government does increase infrastructure spending, like the analysis suggests, then companies that do construction engineering, building materials, things like that, could see a lot of growth.
Right. It's all about following the money and seeing where it goes.
Exactly. What else do you think?
What other sectors stand out to you?
Well, the technology sector is always one to watch.
Yeah.
India already has a really strong tech industry. And with everyone going digital, there's a lot of room to grow in areas like e-commerce and fintech and software development.
Yeah. India's already known for its IT, and that could really explode.
Definitely. And another area is consumer goods and services. With a growing middle class and people earning more, there could be strong growth in things like cars, appliances, entertainment, travel, all sorts of things.
Right, because as the economy gets better, people have more money to spend.
Exactly.
So even though things are kind of rough right now, it sounds like there's reason to be optimistic about the Indian economy in the long run.
I think so. And the analysis reminds us that investors shouldn't freak out when markets go down. It's important to stay informed, think long term, and maybe even see these corrections as a chance to adjust your portfolio and take advantage of some lower prices.
Right. It's like remembering that even the best roller coasters have some dips.
That's a great way to put it.
It's all part of the ride.
And remember what the analysis said, stop checking your portfolio every 5 minutes.
Oh, yeah.
Obsessing over those little changes
Yeah.
can make you make emotional decisions that aren't good for you in the long run.
Makes sense.
Focus on the fundamentals, be patient, and let the market do its thing.
Great advice. So there you have it. We've talked about the highs and lows of the Indian stock market, all the things that are causing this correction, and even some potential opportunities for the future. The main takeaway is don't let those scary headlines get to you. The Indian economy is strong, and with the right policies, it's going to bounce back.
Exactly. And we can learn from all this, adjust our strategies, and hopefully come out even stronger.
That's the goal. Thanks for joining us for this deep dive into the Indian stock market.
Yeah, thanks for listening.
Until next time, happy investing.